Hi and welcome to my channel. For those of you new, my name is Dave and I work in financial services, and these videos are a journey and development towards financial freedom. They'll be about financial products and they're also about improving your financial well-being. So without further ado, let's get into this latest video. So this week's video is about my stocks and shares IC review during the month of March 2022. Okay, for those of you new, the plan is to make a 10% return year on year. We received dividends, hopefully, of £1,200, and we're looking for a year-end value of £80,000. Now, at the start of March, the portfolio was worth £55,709. At the end of March, it was worth £56,710, a profit in the month of £1,001. During the month, we made contributions of £522.30, somewhat quite specific, but we were limited to what we could do because we'd as a result of making that contribution, we reached the maximum amount for the tax year of £20,000 payable into a UK ISA account. Okay. During the month, we received no dividends, but across our dividends, our yield across our 9 shares is averaging at 4.05%, and dividends for the year to date are £22.51. We were charged a monthly fee from our platform provider of £10.19. And if we look at the following chart, a quick overview of where our portfolio is invested. Predominantly UK based, 58.87% is in the UK and Europe. 25.6% is in Americas, and 15.52% is in Asia. With regard to the shares we'll go through in a minute, we've got 9 shares, 5 in profit, 4 in loss, and our shares are worth £23,559, makes up 41.54% of our portfolio, of which 38.68% is in the FTSE 100, and 2.87 is in the FTSE 250. And if you look at the following chart, predominantly based in financial services, but it was done for a reason, something we agree in moving forwards, give us good growth, good recovery stocks, but will give us also some very good dividends, as we'll explain when we go through our shares in a few minutes. Now, let's look at the shareholding we hold within the portfolio. A quick overview of the 9 shares, some of the main points on why we hold them shares. Our largest shareholding is Lloyds Bank. We own 13,500 shares, £6,352, 11% of our portfolio. Okay, it's given great results in February, a good dividend in May. One of the reasons, hopefully, recovery, interest rates have gone up, will be a very long-term buy within our portfolio. Our next shareholding is with one of our ones we've increased lately is Legal & General. We now own 1,602 shares, £4,930, nearly 9% of our portfolio, and we did buy another 212 shares in the month at a cost of £547, but it's given a good yield of 7%, and it will give us a dividend in June of £250. Now, during the month, very good results, and a final dividend was declared of 13.27%. As we said, a yield of 7%. Safe, secure, somewhat boring insurance company, but very cash rich. Our next holding is another insurance company called Aviva. We own 944 shares, £4,267, 7.5% of our portfolio. Again, very good results at the start of the month, a yield of nearly 5%, a final dividend of 14.7p, but it's going to be doing some kind of restructuring. It will be giving a special dividend of £1 a share, and it will be doing a share consolidation. So a very good dividend payable in May. Our next holding is Barclays Bank, 1,479 shares, £2,193, 3.8% of our portfolio, and it will give us a very good dividend at the start of April. Our next holding is Sainsbury's, 788 shares, £2,011, 3.5% of our portfolio, Somewhat struggled lately, but who knows what happens moving forwards. Everybody needs food, everyone needs to eat. Very cash rich company, does pay a very good dividend also. Our next holding was bought for some kind of diversification away from the UK banks. HSBC, we own 231 shares, £1,213, 2% of our portfolio, and hopefully moving forwards it will pay or reinstate quarterly dividends. But again, very good dividends, very good yield, very cash rich. Our next holding is NatWest, the bank. We own 445 shares, £960, makes up 1.7% of our portfolio. Again, dividends were increased during the recent results. And a significant milestone, the government has been reducing its stake. It's now below a psychological 50%. So it's more owned by shareholders than the UK government. And hopefully in the coming months, the stakes will be reduced even further. So the shackles will be off. And it's got some kind of more of a free rein for what it can do in the coming weeks and months. Our next holding has somewhat struggled lately, Card Factory, the retailer. 1,997 shares, £905, 1.6% of our portfolio. Struggled because of debts lately and obviously the COVID and high street closures, but it was very cash rich. It was paying a special dividend. The debts have been resorted. Very good results recently. Debts have been greatly reduced, and hopefully in 2023 the dividends can be restated. And then finally, our smallest shareholding is AJ Bell, the platform provider. 237 shares. It was showing a profit very recently. It did pay a special dividend at the start of February, but the value is now £720, 1.3% of our portfolio. Somewhat struggled, but numbers have been great. New customers has grown very rapidly. Assets under management has also grown, but for some reason the shares have struggled, but it makes up a very small percentage of our portfolio. So a mixture of big safe shares, somewhat boring, somewhat predictable, but some very good results during the month and some very nice dividends declared, which will give us our aims of hopefully reaching £1,200 for the year, average of £100 a month, which will all be reinvested within the portfolio. Moving on to the funds we hold within our portfolio. With regard to the fund values, £33,133 makes up 58.43% of our portfolio. 13 funds, of which 8 are in profit, 5 are in loss. I'm not going to go through all 13 funds, but just a quick overview of significant holdings and may well be recent events. Our largest holding is a technology index fund, £5,255, makes up 9.3% of our portfolio, but a very nice profit since we bought it of over 50%. The tech stocks did suffer during December and January, hopefully recovered, but ultimately long-term players within the portfolio. Our next funding is one we've increased lately. It's a passive advantage fund. Bought across numerous sectors, bought for diversification, and it has got very cheap fees. £4,770, 8.4% of our portfolio. A very nice profit in the recent months we bought of 13%. Our next holding is a global equity fund. £3,991, 7% of our portfolio. Again, bought for diversification. 14% profit since we bought it. Our next holding is somewhat selective, one for the future, shall we say. It's a positive change. So it's bought in companies, hopefully towards the good for the environment moving forwards. £3,700, 6.5% of our portfolio, but a very nice return of 22%. In fact, was struggled lately, but it's back. It's made up 10% profit during the month. Our next holding is a US smaller companies. £3,500, 6% of our portfolio, 19% profit. Has struggled recently, but hopefully sentiment in the US will return Away from the big major players such as the tech stocks, it was bought for diversification. Our next holding is our worst holding performed until recently, was a China fund, £3,062, 5% of our portfolio, a loss of 23%. China struggled in the last 6 to 12 months, okay, will be a long-term player. Hopefully sentiment will return, but it has struggled within the last 12 months. And again, next funds also struggled, an emerging market fund, £1,913, 3.3% of our portfolio, a loss of 9%. Again, like China, struggled during the last 6 to 12 months, but it will be a long-term hold. Other funds we do hold, we own a UK equity fund, we own a small cap fund, we own a European fund. Right down to our smallest fund, really be hammered lately, it's a fund in Russia. It was in profit, we did put £500 in. It went up to £600, very nice profit. Obviously the Russia-Ukraine has massively affected the fund. It went down to £60, it's now recovered, it's at £208. Makes up 0.4% of our portfolio, but a loss of 58%. Who knows what will happen to that fund in future? Who knows what will happen to the Russia-Ukraine contract? But thankfully it makes up a very small portion of our portfolio. But before, shall we say, the war broke out, it was in profit. Okay, it did have some good oil and gas companies, some big banks, but obviously being affected by recent events. So as we can see, okay, 13 funds, some very good funds in profit. Some funds or sectors that have struggled, shall we say, China, emerging markets, Russia. But all bought for a reason, for diversification, okay, all bought for long-term holds. Unless market sentiments change, we have no intention of selling the funds between the next 3 to 5 years, and we may well even top up existing funds as we've done in the recent months. Remember, if you like the videos, smash the like button, subscribe to the channel so we can reach a wider audience, and we'll see you in the next video.